My name is Jeff Noble. I'm Associate Director of Outreach at the Mercatus Center. And this is a Capitol Hill campus program, State of the Economy. It's a quarterly update. So if you have missed any of the previous updates this year, just to let you know, those are all available on our website. So if you want to visit that site, you can see the PowerPoint slides and the video and audio from that day. So please check that out if you're interested in it. Today's speaker is Dr. Bruce Yandle. He hails from Clemson University, where he is Dean Emeritus of the College of Business and Behavioral Sciences. He's also a distinguished adjunct professor of economics at the Mercatus Center. Out of curiosity, how many of you have heard Dr. Yandle give this presentation before? Good. See, that resounding response means that you guys like him. We love him. We're glad he's here. We're always thrilled when he comes. If you haven't heard him, you're in for a treat today. He has a very diverse background. He's been in both academia, public policy, and the private sector, so he brings a lot of different experience and know-how. That's why we hear from you guys that you enjoy his perspective. He is the author of many books, including Taking the Environment Seriously, The Political Limits of Environmental Regulation, The Economics of Environmental Quality, and most recently, Common Sense and Common Law for the Environment. He is a member of the South Carolina State Board of Economic Advisors. He was also a senior economist on the staff of the President's Council on Wage and Price Stability from 1976 to 1978. And he was also executive director of the Federal Trade Commission. And before entering his career in university teaching in the public sector, Dr. Yandle was in the industrial machinery business in Georgia for 15 years. So we are pleased to have him. In front of you, you have his slides from today. Additionally, you have a half sheet of paper in which Dr. Yandle will explain later, but he asks you to make a prediction of the next 6 months. We'll also look at your predictions from last quarter and see how close you were. But please fill that out before you leave. And also, there's a blue sheet that we ask you fill out to give us some feedback on today's presentation and ways we can improve. And so your feedback is of great importance to us, so we appreciate you taking the time to fill that out. But with that, please help me welcome Dr. Bruce Yandle.
Thank you. Thanks very much. Thank you very much, Jeff, and delighted to see all of you here on this lovely day. A little bit chilly around the edges this morning, but I had an unusual thing. I was leaving South Carolina Tuesday morning. It was 18 there, and it was nice to feel something in the 20s when I got to Washington. Get a little bit of a warm welcome. It's a marvelous season of the year, and I hope that each of you is going to be able to shoehorn in a holiday into your schedules. Occasionally it's good for us all to stop and change gears so that we can remember why it is we are working and what it is we're trying to do. The chief purpose, the purpose of all economic activity is happiness. And sometimes we get so caught up in the economic activity that we think that's what happiness is, and it is for a lot of people. We want to do, we may do three things in our conversation today. One is to talk about the U.S. economy, where it seems to be headed, what some of the issues are. Examine whether the Grinch is going to take us and steal Christmas. There's some pretty good evidence that the Grinches may be working on that, but that's another story. But to talk about the economy, the subprime problem, what is going on there, and then to examine a forecast and build that. And the last piece, if we get to it, is to talk about some lessons from economic development. But we don't want to be constrained unnecessarily by an agenda. I want to start by asking you, what are the big issues? And what kinds of questions would you like for us to examine in this conversation today? They may be some of the same ones that I had wanted to, but if not, we'll alter. What are the big issues? Some people suggest that the economy has become the number one political issue, for example, in the presidential campaign. That, according to the pollsters, about 5 or 6 weeks ago, it wasn't. But they say now it is. What's changed? to the extent that the pollsters are telling us something. What is it that's happened that causes people to say, I'm not as worried about Iraq as I am about the economy? What's happened? Yeah. Globalization. All right, globalization is certainly present, but it was there 6 weeks ago. And I'm not suggesting that the economy was not important 6 weeks ago. There were a lot of issues back there. But what we're being told is that it sort of eclipsed, maybe momentarily, other issues, so that it's now number. What else has happened? Yes? Because of what? Okay. So there's a lot of activity going on. There are major questions about let's call it the viability. There are questions about the viability of the banking system at this particular time. All kinds of things are being invented by people who hope that they will be able to apply some kind of policy instrument that will make things better. Things being invented by the Fed, for example. Things being invented by the Central Bank of Europe, applying those things. Things that are being invented by members of Congress, floating ideas as to what might happen that would put a better steering wheel on the economy because of this subprime problem. So that's in the news. We're very much aware of it. What else? I saw another hand up here, I believe. Yes.
One question, which I'm curious about in terms of monetary policy, in addition to the one that I mentioned.
Yes.
My understanding is that even though the Fed has loosened the supply of money, that foreign banks, as represented by the LIBOR rate, did not, lower their interest rates commensurate with the reduction of interest rates in the United States. That might reflect some lack of confidence in the United States banking system. I just wondered, if that might be.
Okay, the question here speaks to different interest rates, short term, charged for money, borrowed by banks. That is, we're talking about a world out there where banks borrow from each other. They borrow from each other, generally speaking, on an overnight basis. That is, banks have to tidy up their balance sheets so that they have the right amount of cash on hand, the right amount of reserves. And so there is a huge market for money among banks. And there is something called the LIBOR rate. It's the London Interbank Overnight Rate, LIBOR. So since it's London, you got a hint there. It applies primarily to banks operating out of the city, out of London. But it doesn't mean that American banks can't go and borrow at that rate. Then it's what we call the federal funds rate in the U.S. The federal funds rate is not a rate set by the federal government. It's called the federal funds rate. It's sort of like LIBOR, where banks in the U.S. borrow from each other overnight. So it's the shortest possible loan. I mean, you could borrow for an hour, of course, but overnight's about as short as it gets, practically speaking. It's that rate that the Fed seeks to influence when they change their policy. That is, when the Fed says we want to make credit more available, they are hoping to affect that overnight rate where banks lend to each other, and the more they pump out, the lower will be that rate. Now, what you've touched on is that the LIBOR rate is much higher than other similar rates, and that's a new development. It happened rather suddenly. In the last 3 months, those rates began to separate. And so for some reason, when banks in London wanted to lend, they were going to charge a higher rate. Nobody sets that rate. It's set by the marketplace. And so it says there's some suspicion as between banks, where routinely they had been lending to each other before. Now they are more cautious in lending to each other, and they've raised their rates because they see a loan to another bank as being riskier than it was 3 months ago. Why? what's happened that would cause the banks to be less trusting of each other. All right, that goes back to the subprime problem. We're talking about trillions of dollars represented by paper that represent mortgages or pieces of them that banks and financial institutions worldwide bought. Most of those loans originated in America. We call them subprime because the borrowers had shaky credit worthiness. But somebody made them a loan for a house. Now, when a loan is made for a house, let's talk about what happens. There's a mortgage. If it were you and I, if we were the ones who borrowed the money, we walk off with a deposit slip. That's some money in a checking account that's now ours. We write a check to the person who was selling the house. Now we're broke again, but we have a house. And now we're talking about how we're going to find enough money to buy furniture, which is sort of the typical thing when people are getting their first house. You know, what are we going to do for a refrigerator? And then you find out you have to put down a cash deposit to get the water turned on. You say, oh, I didn't count on that. All right, so you're a new homeowner. Welcome to home ownership. You got that. The lender has a piece of paper with your signature on it. And a claim on that house if you don't pay it off. It's called a mortgage. But lenders don't keep mortgages. They want to make another mortgage. And so they want to convert that piece of paper that was generated there into money. So in our world economy, lenders, mortgage lenders, bundle up those mortgages and they sell the bundle to somebody else. Now they've got money again and I can make another loan. Now this somebody else, what do they do with these things? They keep bundling until they bundle a large enough bundle and they issue bonds, IOUs, to get their money back. Now, in addition to that, everything about a mortgage can be and is sold. The servicing on mortgages is stripped off and sold to somebody else who is in the mortgage servicing business. That's all they do. They collect. They are like a collection agency. And servicing is bought and sold depending on the riskiness of the underlying instrument. So it's sold to somebody else. The interest rate strips are stripped off. That is the flow of funds that you call interest rates. That's sold. Not the entire strip. It may be in increments of strips off of mortgages. And so they're little pieces of things that get stripped off. All of it originated with an IOU that you signed in a mortgage lender's office. Then what might be left is just pure debt. The interest rate strips have been sold, the servicing has been sold, and now here is just pure debt, and somebody buys that. Or syndicates buy pieces of that. And so if you wanted to go put your mortgage back together again, you might have to go to 50 or 100 places. But that's not a real problem for you. If you have trouble, as that borrower that we're talking about in this hypothetical example, if you have trouble making your payments, you would have heard from the person servicing your loan. There's somebody out there called a servicer. And by law, the servicer can engage in a conversation with you and renegotiate the terms of that loan. It happens all the time. Where you come in and you say, look, we're in trouble, we're late on our payments, we don't think we're going to be able to pay on time. Would you be willing to refinance this thing? Spread it out a little bit so that we can keep our house. Those kinds of conversations take place all the time. But if at the time you were going to have that conversation, the prices of real estate had gone down in your community, and you walked in and you say, hey, I'd like to refinance this thing, we have some problems, cash flow problems. You know, I've been sick, been missing some work. I'm going to be okay. I'll be back at work. My salary is going to be intact. We'll catch up on this loan. Would you give us a little bit of leeway? The lender might say, we can't refinance this thing because your house is worth 10% less than it was when you borrowed. Nobody will accept paper on this thing because the underlying asset isn't worth what it used to be. Now, if we're talking about a subprime loan to begin with, where a person wasn't quite ready, credit-worthy enough to get an ordinary loan, now you've got someone who was planning on refinancing. They learned they can't. Why can't they? Because real estate prices have gone down. And so what's the next alternative for them? Bankruptcy. So they say, we can't make our payments. The bank says, well, then we're going to have to claim this asset. The bank doesn't want that asset. They made the loan in order to get paid so they could make another loan. And so now they've got an asset. What are they going to do with the asset? They're going to sell it. That is, they're not a parking lot for real estate. So you move out, you go back to live with your parents, or you rent a house. This is tough. And that refrigerator that you were real proud of, you're not able to make the payment on it either. And so somebody comes with a truck and a set of hand carts and they haul off your refrigerator. Those are the sad dimensions of personal bankruptcy. And so the bank ends up with a house. They put the house for sale, but we said, hey, wait a minute, prices were falling, and now we got another house for sale in a market that was softening. And so then you begin to get a spiraling effect, and another bankruptcy occurs. In a sense, what I'm giving you is sort of a caricature or a stereotypical explanation of what we have going on. Only we're talking about trillions of dollars, and then we say, well, what are the triggering events? The triggering events, one of them, the one I've described, was soft real estate prices. Prices started falling. Well, where are they falling? They're not falling everywhere. So immediately we know, hey, this isn't a problem that affects every square inch of the United States. Where do you think prices are falling most? Well, the first answer is where they were rising most. That is where the markets were hottest and prices were rising 25% a year in some locations. And people thought, hey, it can't be this good. They were right. There were people buying and flipping and saying, why, I don't even need to work for money, for a living. I can just get a house, buy it, scrape up enough money to get one of those subprime loans, then I'll sell it, and I'll make a few $1,000s, and I'll get another one. Hey, isn't life wonderful? Well, why were they able to get those subprime loans so easily? Well, there's a big debate about that. Mr. Greenspan has been writing in defense of his record as chairman of the Fed. And he says, hey, this thing goes back to a period of time where we at the Fed were fearful of deflation in the U.S. economy. And we made a decision to start pumping lots of money out into the economy to get it pumped up. So if we go back 5 years, the Fed pumped a huge amount of money into the economy, so much that the interest rate was negative. You were being paid to take money. That is, what you were paying to borrow money was less than the rate of inflation. You can't go wrong. Said, hey, I can get a loan. They call it subprime. I'm paying 6% for my mortgage. Prices are rising 25% a year here for houses. Get as many as you can. All right. So we had cheap money, and there was a reason for it in terms of the Fed's responsibilities. We had cheap money, rising prices, and then when things then the bubble. Now that we know it's not there anymore, we can call it a bubble. Then when things begin to relax and prices begin to fall, they fall most where they were rising most. Now where else are they falling? That's not the only place. There are regions in the United States that are distressed economically. There are places where people who I have a friend who's been trying to sell his house in Ohio for 3 years. Not all of Ohio, some of Ohio. And some of Kentucky, and some of Michigan, not all of Michigan. And so then you begin to bump into regions that are in a transformation in terms of their economies, and population is shrinking, not increasing. People are leaving, and you got houses for sale, and you don't have many prospects. And so those are weak, and they are declining. So we have declining prices of homes taking place basically for two reasons. One is they were accelerating rapidly, and people thought it was as good as it could possibly get. It was impossibly good, and they were right. And then we have places where prices are declining because of what I would call real economic conditions. So now we've got a huge amount of housing stock out there for sale in some places. We got a lot of places where none of this problem applies. All right, so it's a real mixed bag. When markets get out of equilibrium, let's call it that, when markets get upset because of some change or some stimulus that started and now it's gone away, we've got a price problem. That is, the housing problem can get resolved when prices fall enough that there are buyers waiting. There are in many places, and they say we better snap this thing up before somebody else does. Prices fall, and eventually the prices fall enough that buyers and sellers start transacting again. And when that happens, in a way, the problem goes away. The question is, how far do they have to fall before it goes away? How many bankruptcies will occur along the way? All right. And so, another question. I've got some other things I'll talk about, but I'm talking too much about this problem. But the problem is worth our talking about a good bit. But other dimensions of the problem. Yes, sir.
If the banks don't lend, they don't trust one another,
yes.
what happens to the velocity of money,
Okay.
liquidity?
Right.
Even though they're pumping, the
Right.
European
Right.
Central Bank just pumped
Right.
$500 billion yesterday.
That's right.
And a lot
That's
of
right.
people say it doesn't matter, the issue is not liquidity, it's insolvency.
That's right. Now but let me go back, because I really didn't say, why is it that they suddenly don't trust each other as much as they once did? And then I said it's because of the subprime problem. But the dimension of the subprime problem with respect to these huge banks, we're not talking about the small local bank that made the loan for the mortgage and they got rid of that piece of paper. We're talking about the very large banks and financial institutions that ended up owning this subprime paper. They're the owners of this stuff now. They got it. And now there are people who are backing off their payments. Now there are people who are going bankrupt. And they've got this paper. There's a law of accounting and finance, rules of accounting and finance, and the Securities and Exchange Commission that require firms to mark their assets to market. When they make their reports to their owners, to the shareholders, they must mark their assets to market. That is, what are your assets worth? It's not what you paid for them necessarily. It's what you can get for them. That's what we mean by mark to market. And so if interest rates go up, for example, and if you or I bought bonds, just as a personal example, if you or I bought United States government bonds and we're saying, hey, I've got $10,000 in government bonds, and somebody says, what's it worth? And you say, $10,000. It's a United States government bond. And they say, do you think you can sell it for that? It depends on the interest rate out there and what the yield is on your bond. If your bond is paying you 5% per year, and new bonds being issued pay 10% per year, you're not going to sell your bond competitively with the 10% bond. It's not worth what it was. When we mark our assets to market, interest rates determine their value, and then also whether anybody's interested in buying the asset at all determines its value. Now you've got financial institutions holding more than $1 trillion worth of this subprime paper, and they haven't been trading it. Bankruptcies begin to occur in large numbers, and now it's near the end of the month and you've got to mark your assets to market, and somebody says, how about assigning a market value to this paper? And the response is, nobody's buying it. And so you have the chairman of the board of Merrill Lynch, who has recently given an estimate to his shareholders that Merrill Lynch is going to take a hit of $8 billion because of subprime assets. And then a week later he says it's going to be $20 billion. And people say, what kind of nut is that? Can't he count? They're hiding stuff from us, aren't they? They knew that all along, didn't they? No. You're talking about estimating the values of stuff that's not being bought and sold, and then all of a sudden some of it gets bought and sold, and you're marking to market. And suddenly your assets have depreciated even more than they had the week before, and you're giving the best truth you can about the situation. Now, it may have been a mistake to have had the stuff to begin with. That's a totally different question. But we're talking about lending now to banks across the street, and somebody says, how much of this paper do they have on their books? You say, well, they've got about $50 billion over there. Do you think they're going to be able to pay their loan on time? They're not quite as credit worthy as they used to be. Now let's back up. The other point that you made. The Fed has a traditional role in a financial institution. All the central banks of the world have a traditional role. They're sort of lenders of last resort. And one of their fundamental roles is to make sure there's enough liquidity out there in times of emergency that the banks are able to operate and take care of the financial side of the economy. For example, after September 11, the Federal Reserve Board in the United States met under emergency conditions, and they said, look, we don't know what this is leading to. The towers had fallen, the Pentagon had been hit, and now they're meeting. Why are they worried? They said when people get scared, what is it they want to have more of? Cash. There are people who are frightened. And so they're going to be going down to the bank to pull out some of their money because they don't know what's going to happen. In other parts of the world where money is gold, there are people who rush to the gold dealer to get something that they can take with them in the event the emergency becomes larger. And so on September 11, the Federal Reserve Board pumped a huge amount of money into our economy. It was a matter of getting trucks from Federal Reserve district banks to haul money to the commercial banks so that if they got hit with a run, they'd be able to service those people at the counter and banks would not have to close. Long story to tell you about how the Fed operates in the face of an emergency. Now, it turned out that the emergency wasn't there. A week or so passes, and it was an isolated event. And so what does the Fed do? They have the capability to go out there and mop up all of that money they pumped in. And so there was one of the largest contractions in the money supply in recent times. They put a huge amount out. It wasn't needed. They pulled a huge amount back in. Had they left it, what would have happened? You would have gotten inflation. Had they left it, you would have had an economy that suddenly is flooded with money, and bankers know what to do with money. They lend it to you and to me. They got a line of people saying, I want to borrow money. Banker says, you're at the right spot. We got it. Come on in. Subprime, don't worry about it. All right. But the Fed cleaned up that money. It's called mopping up actions. They engaged in mopping up actions and sort of went back to the way they were. All right, now we're in a situation where the Fed has these basic tools and they're trying to use them by saying we're going to reduce the discount rate. That's the rate at which banks can borrow from the Fed. They've done that. We're going to pump more money into the economy. We'll take actions that will lead to a cut in the rate on federal funds, and they've done that. They cut by 0.5%, by 50 basis points. And then last week, they cut by 25, so 2 cuts in a row. So now you say they have very attractive rates. They've pumped a lot out there, but the banks aren't lending it. And they're not borrowing from each other. and they've got assets nobody will buy. The reason nobody will buy them is they don't know what their value is or what the value will be tomorrow. So as a result of that, we see some things being done for the first time. The European Central Bank announced yesterday that they're going to make available $250 billion, not on an overnight basis, which is the way central banks usually work, but on a longer term basis, maybe 90 days, at a fixed interest rate. They're going to give you 100% sure thing. So they're saying to their banks, come knock on our door, we will lend you money, a lot of it, at a fixed rate that will be competitive. Then the central banks in Europe and the Fed and the Central Bank of Japan have announced that they will do something very similar. The problem is nobody knows whether it's going to work or not. That's the problem. So you got people going bankrupt, then you got people like me and others who had invested stocks in what I considered to be the safest blue chip stocks that I could buy with my family's life savings. And those stocks are now worth about 25% less than they were. But I'm saying, oh, but they were blue chips and they still are. All right. So there's another effect. There's something called the permanent income effect that enters. Up till now, I've been talking about credit markets and banks and the monetary side. You and I condition our consumption patterns not on the basis of our income today or the income that we made last year. That affects it. But if you study behavior of consumers with respect to their spending patterns, they spend on the basis of what you might call, or what has been called, their permanent income. In other words, if you get some huge bonus, and all of you do that working on the Hill, you get a big Christmas bonus, all right. But if you were to get some huge Christmas bonus, there would be things that you would rush out and buy, but you probably would not use that bonus as a basis for buying a new house that would have higher monthly payments over an extended period of time. You'd say, hey, this is transitory income. Now, the same thing is true if you invested your money in stocks and the bottom falls out, and you say, wow, I've lost 25% of my portfolio. Say, well, we're not going to go and get out of this house and go get another one and sell a car because of that, because you say, oh, it's just transitional. But if it becomes permanent, then you have those conversations. When the expectations of permanent income are affected, then what we might call our permanent consumption patterns get affected. So now we have two things going on. We have a lot of people facing bankruptcy and a lot more lining up waiting, in a sense. They are going to be out of the consumer market. And then you have everybody else whose assets are being affected, and they are not sure whether it's temporary or permanent. The longer it lasts, the more it affects permanent income. And the longer it lasts, the more it affects consumption in the economy that slows us down. Now, we've talked about two things then that could be related in the sense of a recession or a real slowdown. So let's take a look at some stuff. And will the Grinch steal Christmas? We'll talk about that one too. All right, let's see if we can make our, well, there we go. Now, what I'm showing you here, this is the record for the U.S. economy in terms of GDP growth. Those are the light colors. The darker colors are forecasts for the next few quarters. This quarter right here, third quarter 2007, ended in September. That number is being revised today. And probably the revision is out as we speak. GDP numbers are generated three times. There's an early number, then there's what they call a preliminary estimate. That's the second try. And then there is the final estimate. The final estimate for that number is coming out today. The one we're looking at, the tall one there for third quarter, is 4.9% growth in GDP. Friends, that is a lot. That's high-powered growth. Most people expect it to be revised to 5.1, even stronger. Second quarter GDP was 3.9. Friends, that is higher than the trend growth for our economy. First quarter was 1.5. If we average these three together, we get something like 2.9. So, based on what we know, at the end of the third quarter of the year we are in, the GDP was averaging 2.9% growth rate. That's doggone good. Then you get inside those columns and say, well, let's see what's really going on here. A big piece of this third quarter column has to do with the exports of aircraft. Our aircraft industry, our firm, our one firm that is the aircraft industry, is such a global competitor, and it's selling such expensive stuff that their sales can affect the nation's GDP. They did that in that third quarter. The sales of aircraft, not just by that one firm, but aircraft in general, added more than about 1.5 percentage points to GDP growth, just that one activity. But most people say, that's a fluke. It's not going to happen every quarter. In addition to that, export sales generally added 1%. And then another 1% came as a result of inventories that were accumulating in the economy where firms bought stuff and nobody bought it. That's unwanted GDP. So we've got something odd in that column and something that's good but not likely to be repeated. Now here's the estimate for the quarter we're in right now. That's 1.5% GDP growth. That's taking into account slowness in residential markets. The slowness in residential markets takes 1% of GDP, 1 percentage point out of the GDP. That's representing the subprime stuff. Now here, we're underwater. That's the first quarter of next year. That's 0.5 negative. That's beginning to smell like a recession. But it's not one unless we get a second one that is negative. So call it a half of a recession in the year ahead. Then the expectation is that this thing begins to turn around, the economy picks up, and in a way this is maybe an optimistic view of what lies ahead in terms of the economy, saying that we're going to go through very troubled waters. Then the economy is going to catch up, and we keep going. Meanwhile, there will be a lot of people who go bankrupt. Yes, sir.
I know that economists have a tough time forecasting.
Right.
And I guess in your example of Boeing, super
Yep.
sales, an example of that kind of expectancy. Is that the general reason why it's difficult, or are there other reasons why it's negative?
I expect you've identified the nature of the problem. The nature of the problem. The other thing, the definition of a recession is never made until after the fact, and sometimes a year after the fact. It's not defined by the United States government or an agency of the government. It's defined by the National Bureau of Economic Research, which is a private think tank that defines a recession as 2 quarters of negative growth and related problems. All right, so now you got a back door. You can't pin me down. They say, well, you got the 2 negative quarters, but the unemployment rate did not go down a lot. Those kinds of things. But the record is not good in forecasting turning points. Turning points have been very, very difficult for mathematicians, statisticians, economists, anybody else to forecast. It's just like we've got a massive debate that has been going on now for close to 10 years as to whether there's global warming or not. It makes the economists look a lot better. You can't get agreement. There's still a debate as to whether there's any such thing as acid rain. And we've had legislation in place now for years controlling it, but the scientists aren't sure we ever had it doing any damage. At least that was the results of their studies. And so we have a hard time with the turning points. And I guess to some extent, I prefer that there be difficulty in forecasting human behavior because that means there's a lot of it, and they're free. And it's hard to pin them down. In an economy that lacks freedom, it's easier to predict consumer behavior. So it's very, very difficult in that case. But still, that's not to say we ought to, that we can dismiss it with that. The question would be, what could happen that would make this one become negative? Like I think this one will be here. All right. Most of the revisions that take place, I forecast once a year, and I do not change my forecast. Then I forecast once a year, and that you have to have a real sense of humor when you operate that way. Most of the major forecasting units forecast monthly and revise monthly, and still can't get those recessions pinned down, just as you're describing. Part of the problem relates to the fact that what are we using for the basis of our forecast? We're using government data. It's not because it's government data that it's faulty. The data is based on surveys and statistical estimates. It's not all real stuff. And so what is statistical then begins to be ratified or can be ratified by the data. Let's look at this. This is an example of what we're talking about. In the forecasting business, if you want to forecast Christmas sales, Christmas retail sales, your best estimate is back-to-school sales. If parents and grandparents are generous in spending money for children as they go back to school, those same people will tend to be generous in buying things for children during the Christmas season. I'm showing you data for 2003-04. That's the back-to-school period, August and September. That's the Christmas season, December and January. 4-5, 5-6, almost perfect correlation. Now, we don't know what the Christmas sales are for this year. But what we do know, we know the growth in back-to-school sales. It was 0.5%. And so now we can make a forecast. But we could be wrong. But if we were wrong, it'd be the first time if you were using this basis. But that doesn't mean you couldn't be wrong. So we rely on past relationships. And this says, well, the Grinch may steal Christmas in terms of expenditures, but the Grinch cannot steal the warmth that you have in your heart. All right. That's what really matters, right? But I did want to get a Game Boy, too. Yes, all right.
Can't you also, we can look at Black Friday, though. Don't retailers use that day of Thanksgiving as their...
Yep. Black Friday, they call it black because they hope they'll be in the black for the year because of that one-day sales.
Were they this year?
It was not all that good. All right. Now, what we're looking at here, I'm using data for what are called superstores and club stores, like Costco, Sam's, and then the Walmart superstores. In other words, this isn't all retail sales. What I'm showing you here is that category of retail sales. Now, here's a subprime problem of the dimensions of it. We looked at this once before, but since this problem continues to press us, I wanted us to look at it again. All right, that's 2007, 2008, 2009. The data that you're looking at, the height of these bars, represents the amount of mortgages of all categories that will be repriced. Go back to our story. That family that we were talking about that was looking forward to getting the first house and lucky enough to get a mortgage got a particular kind of mortgage. They got an ARM, an adjustable rate mortgage. That's the reason they were able to get a mortgage, is the lender said, hey, let me tell you about this one. Rates are real low, but they're going to adjust. Oh, don't tell me, that's forever. They're going to adjust. You mean they can go up? Yep, they can go up. And they can go down. And they can go down. What do you think's going to happen? Who knows? All right. So adjustable rate mortgages have a fixed rate for a period of time, maybe 2 years, 3 years, and then they hit an adjustment point, and the rate can go up. Well, what happened is the rates practically doubled. When the rates practically doubled, you've got a monthly payment that has probably tripled. All right, now this is all. The darker color that you see in here, if you can see, you see that little thing that looks sort of gray? That is separating. All the tall, dark stuff is subprime. That's the magnitude of the subprime harvest that is out there. Now here's 2008. You know, here we are now. More and more of this stuff is happening. Repricing, more people go bankrupt. So it's not over. Here's 2008. 2009, that aspect of the problem is pretty much gone. And so it's a rolling problem. The extent to which it is serious, very serious, relates to interest rates. If interest rates go down, and now we get back to what central banks are trying to do, pump money in, make more credit available, so forth. If rates go down as a result of those actions, then the bankruptcies associated with this repricing will go down. And that's unknowable. We can't know. All that we know is a huge amount of effort that is taking place. I'm going to get beyond these because the colors don't come out real well. I want to give you this one right here. I base my forecast on the economy, on money coming into the economy. Fed puts money in, things speed up. They take money out, things slow down, so I watch that. I translate that into industrial production for the economy. That's a nice statistical fit. That's why I do it that way. And then I translate industrial production into GDP. What you're looking at here, the kind of mustard color line is GDP growth. Now, when we talk about trying to forecast turning points, you can see we got a lot of them. All right. The mustard color is GDP growth. This blue color is industrial production growth. And so they zig and zag together pretty nicely. In fact, as you get over here to the more current period, they really are moving together nicely. And by the way, talking about one of the things that makes it difficult, I don't have the slide with me. We've seen it before, and I can pull it out. We can't predict Fed behavior with respect to money coming in and out of the economy. And believe me, it's not like that. It's like that. It's doing like that, and that is what is generating these wiggly lines. That's the most recent industrial production data for a quarter. I've taken industrial production data now that I can forecast out in the future, and that's what I think GDP growth is going to look like, going on out into 2008, and that's the number. That's the chart that we looked at earlier. So I wanted you to know that I don't just crank out the numbers by going and looking at robin nests in my yard. That might be a better technique, but I tie it into the behavior of the bank. Here's employment. Now this is to show you that our economy has been slowing down in terms of jobs and employment for quite some time. This last observation that you're looking at here is for October. The trend line is going through that, and where the trend line, where the bar lies right on the trend line or below it, it says, hey, we're losing ground relative to record. Where we are above, we're gaining ground. what you're seeing now is an economy that has been slowing down by looking at the numbers, and now the slowdown is being accelerated. This is unemployment by state. That's 2003. That's October 2007. And it's in there that you can see Michigan, you can see Ohio, you can see Kentucky. You can also see Mississippi, that's Katrina effect. And you can see a couple of western states with higher unemployment rates than the nation as a whole. You see that part right in here that's just doing incredibly well. There's not much subprime problem in those wonderful square states. And on the Rocky Mountain border, not much subprime problem. A lot of subprime problem over in those western states, a good bit in Georgia, primarily Atlanta, and then in that industrial central area that we were talking about, Michigan and Ohio. And this is per capita GDP for the nation, looking at it by states. The lighter the color, the weaker the economic growth. And now if you're from a state that has a high subprime problem and it happens to be a state with low GDP, then on a per capita basis, you've got vulnerability. That is, the low GDP per capita states may not have a subprime problem. South Carolina is not severely affected by the subprime problem. There's some effects, primarily in a place called Sumter, and then some down on the coast. But it is a state with low GDP per capita. If we had the subprime problem and that, then you might want to have an alarm going off in terms of economic signals. Now let me stop and see if there are other things that you want to touch on that relate to the general outlook for the economy and the subprime problem. Any other questions on that topic? Yes, sir. Not much. Let's talk about that. Let's put that in the context of CPI inflation. When you see numbers on Consumer Price Index as a measure of inflation, came out last week, the most recent one. When you look at that number, November, the number you got was for November. If you look at the rate of growth of the CPI, November over November, November 2007 to November 2006, it is 4.3%. That's high. We've got a 4.3% inflation rate, all items included. Then people say, well, let's take out gasoline and let's take out food. If you take out gasoline and food, sure does feel a lot better. Just 2.7. We don't have any inflation problem. My response is, have you ever tried to live without food and gasoline? So we've got two things that are really racking across the typical consumer's budget. The gasoline prices, while at $3 or higher, represent a high number in relative recent times. It is still not as high as numbers we've dealt with in the past in real terms, but it's still real in the budget. Food. Now we're talking about 15 or 20% of the consumer's budget. The run-up in food prices is attributed primarily to, guess what? Ethanol. Ethanol production. Ethanol production is running up, that is, the run-up in the production of corn, the run-up in the production of ethanol, highest corn prices in a long, long time. Then we put barriers up, made it illegal for us to be able to import ethanol from another country. We're protecting the ethanol producers from international competition. And you've got people with other countries that have lots of ethanol they would like to ship over here. Nope. All right. So we've got an ethanol deal. We're producing a lot of ethanol. Everything that has grain going into its supply line. Have you bought 2 quarts of milk lately? Have you bought a dozen eggs lately? All right. anything that is fed on grains. Price of rice is rising worldwide. Severe problem for those populations of people who have rice as the primary ingredient in their diets. Much of that is being driven by an ethanol policy. One of the serious problems, according to a friend who is with the U.S. Forest Service, we're taking down forests to grow corn. All right. Allegedly to protect the environment, to make it better. So now we are eliminating trees, eliminating forests in order to grow corn, in order to produce ethanol, and we're getting that inflation effect. There's a lot more to take into consideration if you're going to try to evaluate that huge policy, but that's one of the drivers. All right, so we've got high inflation that is eating away. Now that's going to be taking away the purchasing power for the typical family. Then that begins to affect the permanent income behavior that we touched on earlier. Any other questions on that point? All right. I want to, I'll come back to these, but I want to get to this. I mentioned that I make a forecast the last December every year, and then I do a kind of scorecard along the way to see how the forecast is holding up, and then I try to come up, I try to cook up explanations as to why I was so dumb when I made it. I show you in the first column what the actual values were on the 31st of December 2006 when I sat down and made a forecast for December 31st, 2007. So you can see GDP in 2006 grew at 3.2. I'm forecasting 2.5 for this year that we are in. If the softness that I'm expecting in the fourth quarter shows up, we'll be at 2.6. There's my forecast for 2008, 2.3. CPI inflation, this is core inflation. Pretty much constant expectation that core inflation, that's leaving out the food and the gasoline, the fuels and energy, will be higher in 2008. You can run down the chart. You can see what I was forecasting for the 30-year fixed-rate mortgage. I was forecasting 6%. It's at 5.88, according to Bloomberg this morning. I expect it to be a little higher in the year ahead, and so forth. Now here's where, this is really feeling good right here, but it's kind of painful because we know this Dow has been up to 14,000 this year. So this doesn't look all that good for those of us who remember those good days, but it's getting pretty close to my forecast. That's what I expect for equity movement in the year ahead. I was really off on employment growth. It's much slower than I had forecast. Maybe I'll be closer this time. But here's where I really goofed. All right. I was forecasting the price of oil to be $45 a barrel. We got, about 2 more weeks before the end of December. We're right here at 91. I expect it to be more likely to be 100 than to be 45. And then these numbers sort of run together. That is the price of oil, price of gold. They move together. Part of that run-up is associated with the weakness of the dollar. That is, the dollar has gotten weaker in terms of its purchasing power of stuff other people produce. One of those categories is oil. Another is gold. We don't produce a lot of it ourselves. So when our dollar gets weak, these numbers rise. Then they're rising for other reasons as well, inflation and so forth. So that's the forecast. Now, let's see. When we met in September, I gave you 3 choices. They were not, I didn't do a good job on these choices, and most people picked the one that was probably, where you would say, it's probably the safest choice, but it turns out not to be a real good one. We had 3 choices in September when we met. First one says the economy will be hurting from the housing fallout. We're talking about the next 6 months now. We've only gone 2 and 3/4 right now relative to that forecast. GDP growth will barely break 2%. I think that's the case for the last half of this forecast period. Oil prices will fall below $70 a barrel. There I go again. I missed that one. Fed will cut rates one time. They've cut it twice now. But we still have so much to go in your forecast. The Dow will accelerate again, hitting 14,000. It sure did. 40 people who were in the room picked that one independently. Then here's the second one. Nobody picked it. The third one, the economy is going into a recession. 2 consecutive quarters of negative GDP growth are now in the cards. $45 oil, 12,000 Dow, 3 interest rate cuts by the Fed. Only one person picked that one. Now here are the choices for the next 6 months that I'd like to ask you to look at and make a choice. But I want to talk about the third one while you're looking at these. It's sometimes something that is overlooked, and for good reason. The third choice says, hey, we're in a political cycle. That is, in addition to all the other forces that are playing through our economy, it's a presidential election year. And if you were the administration in office, you might be inclined to think that it would be better for your party if the economy was not in the tank. You know, you might just think that. For good reason. And so if you started thinking like that, you might be inclined to say, well, what can we do to keep this thing from being in the tank? Well, that might be a good thing to think about anyhow, right? But given the election cycle, then there gets to be a question, well, what could the administration do? What powers does any administration have that could make the economy come alive here so that that would be off the minds of people voting? And as they used to say, it's the economy stupid, it's pocketbook issues that finally determine votes. What could they do? Well, what I'm suggesting here is that the Fed, which is independent, is made up of human beings. Those are human beings too. We're all human beings. And they're independent. That is, the president doesn't run the Fed. Congress doesn't run the Fed. But everybody pounds on the Fed. You hold hearings and people storm at the chairman of the Fed. What are you going to do about this? And probably the same thing happens in the White House. It's possible for the Fed to become somewhat sympathetic and then to engage in more opening up of money than would be the case otherwise to juice up the economy. Now, having said all of this, a lot of people have examined a hypothesis. That is, looked at a lot of data to see if they could find a period where it appeared that the Fed really did end a president or the reverse. And they find only one. That is where, statistically, on the basis of the behavior, it appears that there was a kind of accord or a discord where a Fed decided we want to get these guys out of office and behaved in a way that would have predicted that. But I ask you to think about it. With the caveat, as I ask you to think about it, that there's not a lot of statistical evidence that this happens. But it's also hard to predict those turning points, too. All right. How many of you are leaning toward one? Okay. What about two? Got anybody for two? Got a few for twos? All right. Anybody still thinking about three? All right. All right. Yeah, you might want to fill in the blank. Yeah, you might want to fill in the blank. Blend some of those. Yes, sir.
What was the case where statistics show that?
I believe, if my memory serves me right, it was Bush 1. My memory serves me right. And in that evidence, it appeared, in other words, the economy was turning, but nobody knew it. The economy was turning, and nobody knew it, which is to say it didn't turn fast enough. All right. That is, we tried, but it didn't turn fast enough. It's that kind of evidence that comes out. But most of these tests are not very successful in terms of making a prediction. All right. Any other questions now on the general economy? Yes, sir.
Question: in your forecast, you've got a core CPI rising.
Yes, sir.
8%,
Yes, sir.
and you've got oil and gold going down.
Yes.
And the implication of a rising CPI suggests a falling dollar.
Yes.
And the question is, if the dollar's falling, how can oil and gold go down as well?
All right. We're right in here in terms of the question that's been posed. I'm predicting oil will be cheaper and gold will be cheaper, but higher inflation. And very logically, you'd say inflation, the dollar gets weaker, these numbers get larger because of inflation effects. What would cause them to go down? All right, but let's move away from the monetary part of it. All right, falling demand. So if our economy is weakening, our unemployment rate, slower economy, not using as much energy, so weakness on the demand side. What else? Increase in supply. That is, yep. But in terms of the basic supply and demand of the commodity, right now the oil production in Iraq is the second largest producer of petroleum. Saudi Arabia 1, Iraq now is number 2 in the world. It is now at a level above what it was before the invasion. Well, that suggests that it could get even better. But if you get additional supply, then the other kinds of considerations would be political. 90% of the crude oil produced in the world is managed by government, so it's a political commodity. So I'm trying to be optimistic in that sense that things will get better in terms of the politics of oil, but a slower economy.
Will Chinese demand take up some of that supply?
I expect so. Yes, I expect so. I expect the growth in the China economy could easily absorb the growth in the petroleum. Yes, sir.
What if we did a war with Iran?
It's not in my forecast. Good question. But let's get some responses. What if we go to war with Iran? Think about the oil up. And you might say everybody who's a friend of Iran, that is OPEC, reacts negatively. I mean, let's say they go to war. So you get that effect. What else? Anybody else want to throw another item into the hopper? If we put going to war with Iran into our forecast, it's not there now. Pardon? Right, okay, all right. So if we want to go down, if they're going to hoard cash, they also would want to hoard gold in that gold part of the world, which is the part of the world where we would be having war. So we would expect to see higher prices here, higher prices here. Who knows what the Dow would do because it's so forward-looking. Might sell a few more airplanes, all right, so that exports would go up, maybe. But those are the kinds of things to think about as you let your mind float across the data. I wanted to mention to you something that you probably know about in terms of the oil economy of the world. The United States has the largest deposits of coal in the world. We're big time on that. 50% more than Russia, which is second to us. We have the world's largest stock of shale oil, more known reserves of shale oil than all of the oil that has been extracted from the earth since the beginning of time, Titusville. It's all on federal land. So we've got a humongous supply of oil in the United States. greater than anything anywhere else in the world, but it's on federal land, and it's shale oil. All right, you got to get it out. So there's a price at which it becomes competitive. But worse than that, it's not a matter of price. There are severe restrictions on getting that stuff, perhaps for environmental reasons. I was meeting with some people this morning who are working on regulations, and they were asking me about how one would track down, how you would follow regulations and attempt to trace the economic effect of regulations on particular industries. The scholars I was meeting with are looking at the Federal Register and the Code of Federal Regulations. We'll try to follow the development of rules and so forth for a particular industry. They're trying to identify both corporate welfare, that is regulations which subsidize and strengthen industries, and regulations which impose costs. And I was telling them about this shale oil, this huge amount of energy that we have locked into our country, but that they should also look at appropriations language. That is, if you're reading the Federal Register, or if you read the Code of Federal Regulations, you will see regulations that say you're supposed to do this, this, and this. But if you read the appropriations language each year in the budget, you will also see not $1 shall be spent on. In our appropriations language in this budget, not $1 shall be spent on the development of regulations having to do with shale oil. Now, I would ask you, as we wind up, who would be interested in that restriction? Who would have lobbied? Who would have lobbied? That is, in a country and in a world where people seem to think we've got an energy problem, who would have lobbied to say, let's make certain that we can keep that stuff locked up a little bit longer? All right, the oil industry. Another one? The ethanol industry. All right. Another one? We've named two bootleggers. How about giving me a Baptist? Environmentalist. All right. Because this is dirty stuff. I mean, it's not to suggest that, hey, this is Mr. Clean, but that was the purpose of the regulations, to set restrictions and to get everybody together as we do in this country in a regulatory sense. Let's see if we can figure out, let's see if we can find a path through it. So you've been patient. Thank you so much for your attention. I don't want you to slip out without wishing each of you a wonderful season of happiness. Get out and have some fun so that you can remember why you work so hard. All right? All right. Thank you a lot. It's good being with you today.